Hey guys, welcome back. In today's video, we are talking about the Citadel leverage being destroyed, margin calls issued, increasing shorts, and many more in this video. First, we're taking a look at this. Wonder why AMC isn't moving today? Or maybe because it's the 70% of the orders going to dark pools. And where you take a look at this, so once again, we are faced with, the dark pools, the price manipulation. Now, this isn't a surprise. When you take a look at what's happening today with the Nasdaq and S&P all up, and Nasdaq being up 2.7%, we're seeing now AMC being suppressed once again. Now, firstly, that obviously indicates the collaterals going up. We talked about this, understanding how because these stock value are going up, they then get liquidity, but it's to also show that it costs them money to do this and that they are worried about AMC, because in the market where every single stock has pretty much gone up today, the ones that have actually suffered were AMC and GME. Now, that shouldn't be the case, considering that we should go up along with the market, but that happens to be the case because of the fact that shorts want to bring us down. Now, there's a big reason for why shorts want to do this. When you take a look at already what's happening, you can see Citadel is heavily leveraged and relies on repurchase agreements and margin financing. China dumping bonds will destroy Bank of America and Citadel. So you can see if Bank of America were to face a severe collapse, it could have major impact on Citadel securities, since Bank of America acts as the clearing broker for nearly all of Citadel's net derivative assets as of December 1st, 2024. Given Citadel's heavy use of leverage and reliance on repurchase agreements and margin financing, a disruption of B of A could trigger forced asset sales, margin calls, and liquidity issues for Citadel, potentially magnifying losses and operational risk. Basically, Citadel's exposure to B of A as a critical counterparty means that a Bank of America crisis will likely ripple through and stress Citadel's positions and risk management. So now you understand the relationship between Bank of America and Citadel. However, another way to also look at it, so what we are seeing here is that if Bank of America were to face a severe collapse, Citadel will be affected. But you can look at this the other way around as well. If Citadel were to face a severe collapse, it could also have major impact on Bank of America. So they are obviously tied in with each other on both ways. And when you understand exactly what's going on, we talked about how firstly Bank of America is the prime broker and also the prime lender for Citadel. Now, going back to what we talked about here in terms of understanding that Citadel is also one of the biggest shorters of AMC, of course with the synthetics and the naked shorts that we've mentioned in the past. And so knowing that because of all of this, because that they are over leveraged, because that at any point were AMC and GME to go up drastically, they will have heavy liquidity issues. And these heavy liquidity issues will then also transfer to Bank of America, who right now are also already facing the liquidity issues because of the recent volatility in the market. You have to understand, right now we are seeing banks that are over leveraged with trillions of derivatives positions. We have to also understand that Citadel has posted a loss in both February and March, and very likely April as well. So neither of them are doing well, hence why they can't take any risks with AMC nor GME. And so it's at times like this, when we're seeing the markets go up, when we're seeing that AMC and GME should also go up along with it, we're seeing the suppression happening because they have to maintain the margin, because they are worried. And it's why we're seeing margin issues being actually warning out right now. You can see, given recent market volatility due to tariff news, the OCC would like to remind members of the intraday margin call process. Now, essentially, this is a margin call warning. Now, if you've backtracked just a few weeks ago, we've already been seeing margin calls being issued out. Now, obviously not to Citadel, but to some smaller firms who are over leveraged. And this has always been a problem because we knew that no matter which short seller it is, no matter what institutions, they are all extremely over leveraged. And so everyone's obviously extremely scared when it comes to a time where volatility is at its highest. You can see here, margin call warning issued, who is over leveraged. OCC may require the deposit of intraday margin by a clearing member in any account at any time during any business day. And so what it is that the calls are generally issued during a pre-designated window, which occurs at or around 12 p.m. CT. Now, the minimum margin call is 500,000. Members are required to meet such calls within 16 minutes of issuance. And so this is firstly just understand that right now we are seeing firms really struggle with liquidity. It may be the smaller firms, but we've definitely seen that happen with the bigger firms as well. When you take a look at some of the indications, some of the clues that's been left behind, the very fact Citadel had to raise money just to pay back the investors, despite being profitable in the billions, shows that they are very tight in capital, because it's very likely that whilst they have made profit, the profit is still tied up and not actually realized yet, or that they can't take it out without their positions being margin called. And so we understand that they are in a liquidity crisis. And it's very coincidental as well that as we're seeing this margin call warning being issued, we're seeing a 70% in the dark pool for AMC. And so when you link these two together, things start to make sense. Dark pool increasing for AMC, as we're seeing a liquidity issue happening for the short sellers. And so another way to also look at it is understanding, as we're seeing shorts getting closer and closer to getting margin called out of certain positions, they are suppressing certain stocks from going up in price to obviously limit the margin calls. And that's why we talked about how these firms are struggling right now with everything that is going on. You can also see, again, another thing to look at is just in huge, so this was in regards to yesterday, GME popped to 30.69 in overnight trading, one of the biggest yet. Yes, it will be slammed down, but great sign. So another clue left behind. So before we started the trading day today, when we saw the Nasdaq and all of these things, all bounce up, we saw GME actually going up as well yesterday. And now going back, the same example, as we're seeing these margin calls being issued, in these warnings being issued, we're seeing how GME was going up. We're seeing how the dark pools are going up. They're all showing signs of how we were seeing suppression, or how they knew something was going to happen because of the indications that were given. So prior to seeing AMC with the 70% dark pool, they obviously would have saw that GME was at 30.69. Hence, they were already seeing liquidity crisis. Then later on, as they knew that if AMC were to go up as well, they will see an even bigger liquidity crisis, hence the 70% dark pool. So you can really start to see how these puzzles are starting to fit in together. And what we have always talked about with the liquidity issues, it's all happening right now. You can also see 920% short volume alert for GME. Again, this is just another clear indication of what's going on. Why would we be seeing the short volume going up if there isn't something to do with GME? Why would they try and suppress GME that much when we're seeing how well they're doing? Yes, we talked about the fundamentals. Yes, we talked about how whilst GME doesn't have a fully operating business structure, they have billions of cash and have invested in Bitcoin and is able to collect hundreds of millions in interest. So they are doing well financially. AMC fundamentally are doing well as well. This is something we've always talked about in our videos. So why are they trying to short two stocks that are showing extremely good fundamentals and is primed for value investment? Well, because they need to bring it down so they don't get margin called. Again, you can understand why we talked about the margin call warning is just a massive indication of what's happening. You can also see Susquehanna Corp playing ETF dress up again, off exchange unreported, and with zero regard for transparency. Violated rules on off-exchange options creations, failed to notify NYSE ARCA, got slapped by the SIBO and NYSE, and this is what we are seeing. Shorts scrambling to find ways to get out of this. This is just another example of what they are doing. In this video, we've shown you the things that they've done to obviously suppress and manipulate AMC. We've shown you why they want to do it. And another way of understanding the short interest going on is hype dates comes and go, but one thing for certain, XRT short interest has once again ballooned up 430% as they create and redeem at unprecedented levels. Since this is the main vehicle used to short GameStop, one can summarize that the recall is on track, even if they decide to attack GME aggressively. Now, this is what we have seen. This is something that you will be seeing throughout last week and this week, the XRT going up. which is what they use to short AMC and GME, because it's another way for them to try and find shares in order to short AMC and GME. Now, pair that up with what we just talked about with understanding the 920% short volume alert, and if that wasn't enough, we're seeing 430% on XRT, and you can even see here, there's something we've highlighted. The shares outstanding, 4.8 million. The shares short, 20.9 million. Already the creation of synthetics, and going back to what we talked about with Susquehanna, you can see exactly what is going on. So thanks guys for watching this video. I'll catch you guys next time.